After studying this module, you shall be able to know the concept of international banking and its basic operational features, understand the motives behind internationalization of bank, know about the modes of internationalization of bank, understand the need to control international banks. The progress and growing integration of the world economy has been supported by the equivalent growth of the global banking functions as different commercial banks started following their customer beyond national territory. There are two parameters to distinguish between international and domestic banks. First one is the location and the latter is counterparty. If the borrower or depositor is a foreigner, then transaction can be treated as international. Traditionally, transaction is considered as international if it is done in non-domestic currency. In this section, firstly, a brief introduction is given about international banking and its basic features. However, in later parts, information about motives of bank for operating internationally, modes that can be used by banks for international banking activity and need to regulate international business activity is given. Concept of international banking. After World War I, world economy witnessed exponential growth in financial transactions. Recent studies shows that trading in financial assets is 10 to 15 times those in goods and services. There is further expectation that it will grow in faster rate, and the banking system is a center of rising financial operations. The second wave of growth in the international banking occurred in 1960 and accelerated by the expansion of offshore American commercial banks. The second phase of growth also led to widening of the range and scope of product offered by multinational banks. Presently, these activities are included in multinational banking, trading in foreign securities market, borrowing and lending in foreign currency, dealing in derivatives, gold and precious metal, provision of trade finances, participated in euro markets, provision of corporate finance across country. Multinational banks also actively involved in providing those services which is provided by non-multinational banks. One such activity is foreign currency trading. Multinational banks are those banks own and control banking activity in two or more than two countries. Although some other authors has used narrow definition of multinational banking so that a line of difference can be maintained between multinational and international banking. The main issue with the former definition is that it can be interpreted to include banking activity that does not require a physical offshore presence. A better example of this can be understood from the euro markets. It is relatively simple for a bank to involve in euro markets loans and fund these loans in non-domestic markets without having a physical presence offshore. International banking involves two kinds of activities. The first one is traditional foreign banking, in which involved provisions for transactions in the domestic currency to non-residents. These services are provided by both domestic and foreign owned banks which are located in the host country. The second kind of activity can be called onshore euro banking. In this, banks indulge in euro banking, keeping intact their home market. Offshore banking can be partially treated as a part of international banking. Offshore banking is concerned with providing banking services in foreign currency without departing the bank's home base. Some types of trade finance and foreign exchange trading are included in this type of activity. Multinational banking is different from the international banking by the physical location of the activity. Specifically, multinational banking is differed by banks having a physical presence that involved in providing banking services from a place outside the country of incorporation of the parent bank. Motives behind the internalization of banks. One important question which is needed to be answered is that why firms go for internationalization? One of the pioneer studies given by Goebbels 1977 explains that is the spread of multinational company that encouraged the banks to go internationalization. This is a common and natural phenomena as they used to follow their customers in international market. When any enterprise moves towards abroad and establish their subsidiary there, then banks to move there to provide banking services to the customer. Since subsidiary bank close to parent's bank, therefore they are able to serve client in a better way. Hence, banks enjoy edge over the other bank and encourages them for international operations. Gruel also said that in comparison, domestic banks, international banks operate at a higher spread. This means interest rate on deposited accepted by international bank is higher than in the case of domestic banks. However, interest rate on lending of international banks is lower than in case of international banks. This gives incentives to domestic banks to go international. Aliber 1984 described that it is a difference in cost of capital that pushed them to go for international operation. In developed country, capital available in abundant nature, therefore cost of capital is low. However, in developing country, capital is not abundant and therefore capital is very costly. Viewed from the above angle, bank move its operations from developed countries to developing countries. According to the Ruman 1984, it is a diversification factor which brings stability in profit of the banks and reduces their systematic risk. More a bank spread their branches, greater the benefit of diversification. In the view of Dunning 1993, ownership advantages lies in the transactional clients, economies of scale, access to the international markets, higher intrinsic value of reserve currencies, professional expertise and control over the trans-border communication network. The internalization advantages that can be taken by international bank are economies of coordinating capital flows, quality control, etc. Levine refers to the two factors which encourage banks to go for the internationalization. These are custodial function of the banks and the avoidance of regulation. Custodial services are given to those clients who makes investment in overseas securities. The banks have to collect dividend, collect securities and other related services. As the clients are going for multinational operations, the bank required to have overseas offices so as they can serve their clients. However, there are some empirical studies which show that banks should go for internationalization. Curie 1980 specified that increasing in international trade and investment opportunity has pushed them to operate abroad. The research of Fieldheck confirms that there is a positive correlation between US foreign investment and US bank branches abroad. Also, Goldberg found that growth of external trade and government control on capital flow motivated them to go international. Modes of internationalization. The procedure of internationalization is complex and there are a number of ways in which banks can go for internationalization. In initial stage, banks create an individual department for dealing with international business operation. With the growth and expansion of business, department is further bifurcated on the basis of their function. When the business grows further, department is not capable to manage business and parent office begins moving abroad in different ways depending upon the volume, rule, regulation and culture of the host country. Correspondent banking. Correspondent banks works as a mediator to clear transactions between banks. These relationships make possible for a bank to meet the funds requirement of domestic customers, foreign exchange and trade dealings. The domestic bank deals with foreign bank to work as its agent for transactions in that foreign country. Correspondent banking has the edge of being a comparatively low cost method or reaching a market, specifically market where operating costs are huge or regulatory obstacles to entry are very high. By involving in international correspondent banking, the domestic bank has low cost access to the expertise of foreign banks, corporate and international departments without bearing establishment cost of a physical presence offshore. Representative offices. A representative office is a small office in the host nation that coordinates a bank's correspondent banking relationships and renders services to the bank's existing customers. The office often has an auxiliary role of distributing information about the parent bank and gathering information about the host country. Representative offices neither have liability nor have assets. Instead, they search for information about the host environment to find out whether business opportunities available in the host country is profitable or not. Representative offices are often used to conduct matters relating to correspondent relationships such as check clearance, trade transactions and foreign exchange matters. Representative offices can be run on relatively low budgets and as a result can be easily opened and closed. Agencies. Agencies provide benefit over representative offices in that they can conduct transactions. The activities allowed to agencies vary according to the host country laws, with some nations prohibiting agency activity by multinational banks. The limitation of agency is that it cannot raise or solicit deposits. However, there may be exceptions. Some countries allow agencies to accept credit balances from residents that are linked to specific purposes. Consortium banks. A consortium bank can be treated as a joint venture bank solely incorporated and owned by two or more shareholders who are banks itself, generally belong to different nations. Consortium banking is the only viable method for small and medium sized banks to access the euro markets. The consortium bank allows capital and expertise to be pooled to the mutual advantage of the participants. Some consortium banks are formed to cater service needs of a particular market segment, such as cross-border mergers and acquisitions or project finance. Another cause for the establishment of a consortium bank may be to reach a particular geographic market. Some nations have banking regulations that require host country participation, and as a result, a consortium structure may be appropriate. Merchant bank subsidiaries. A merchant bank subsidiary is an investment bank that is wholly owned by a bank located in foreign country. It offers an option to bank for entering a host country without the constraints that may be imposed on a full banking entry. Such a subsidiary generally offers the whole range of wholesale services but would be suffered by lower credit rating than would be the case with a full banking license. This lower credit is due to the fact that merchant bank subsidiaries are not subject to the same level of prudential supervision. EDGE Act Corporation. EDGE Act corporations are an organizational structure unique to the United States. The EDGE Act, which is an amendment of Section 25 of the US Federal Reserve Act, allows US banks and foreign banks to conduct international banking and finance activities in states outside their state of incorporation in the United States. EDGE Act corporations can conduct a wide range of banking activities, including accepting liabilities other than savings deposits, financing international trade, and making loans. These activities must be related to international transactions. Bank branches. A foreign bank branch is a branch located in a different country other than the country of incorporation of the parent bank, without the branch itself having separate incorporation. As such, the branch is internal to the parent and is not separately capitalized. The branch will carry on banking business depending upon to the laws of the host country. The limitations imposed on foreign branches are that they generally have the ability to offer a nearly comprehensive range of banking services, with restrictions on access to the retail market being usual. As the branch is not legally separate from the parent, it has access to the full support, credit rating, and capital base of the parent. Bank subsidiaries. A bank subsidiary is a separately formed bank that is controlled by a parent located in another country. Such subsidiaries are generally wholly owned, as this reduces potential problems associated with dissenting minority shareholders. The host nation regulations imposed on foreign bank subsidiary often determine whether this organizational structure is chosen. Generally, as discussed above, multinational banks prefer the bank branch structure to the bank subsidiary structure. However, in some cases, the host nation regulator will not allow foreign bank branches to be established, mainly due to the concerns regarding prudential regulation. Controlling the activities of international bank involves two basic questions which need to be answered first. The first one is that why there is a need to control the activity of international banks, and secondly, how they can be kept under the limit. The why of control. There are four causes which generate the need to control the activity of international banks. International banks are one of the prominent players which lead to the increase in the stock of money supply and therefore lead to the rise in inflation. Sometimes these banks are responsible for banking system failure that distorts the interest of depositors. This will happen because banks take off a good amount of cash to other countries and the problem of liquidity occur in the domestic banking system. They charge high interest rate, which further leads to uncontrollable indebtedness among the borrowing government. They are rigid to adopt credit allocation policy of the host government which is derived from the socio-environment of there. The next is the how of control. There are different ways to control the activities of international banks. Some of them are as follows. One way to restrict the activities of international banks is to impose statutory reserve requirement on them. This tool is also helpful in ensuring equity between domestic and international bank and to put check on disintermediation of banks. It also helps to improve the efficiency of monetary policy of the domestic country. It will also increase the confidence of the investor who conducted their business outside. However, this method suffers from following limitations. No doubt that it is possible to check disintermediation, but if international bank will try to find new ways, then it may be more dangerous. Secondly, if only few governments impose statutory requirement for international banks, then it will not remain effective as bank will move their branch to those countries where there is low regulation. There should be some restriction on convertibility of currency. Third way is moral persuasion. International banks should be regularly checked so that they does not take any step that wipe out the interest of host country and domestic country. Some amount of control should be imposed on non-banking financial institution. The most appropriate method is to raise operational standard of domestic banking system so that they can be competent enough to face challenges posed by international banks. The progress and growing integration of the world economy has been supported by the equivalent growth of global banking function as different commercial banks started following their customer beyond national territory. The activity are included in multinational banking. First, trading in foreign securities market. Second, borrowing and lending in foreign currency. Third, dealing in derivatives, gold and precious metals. Fourth, provision of trade finances. Fifth, participated in euro markets, and sixth, provision of corporate finance across country, etc. Multinational banks are those banks own and control banking activity in two or more than two countries. Although some other authors have used narrow definition of multinational banking so that a line of difference can be maintained between multinational and international banking. The main issues with the former definition are that it can be interpreted to include banking activity that does not require a physical offshore presence. International banking involves two kinds of activities. The first one is the traditional foreign banking and the second one is known as onshore euro banking. International bank can be of different types but function is same. The main motives behind internationalization of banks are tremendous growth of international trade. They are manifest also in different interest rate and benefit on account of global diversification. The international banks can use different modes to operate in foreign market like through representative and correspondent office, through merchant banks and consortium, through agencies and lastly through branches and subsidiary banks. The main functions of international banks are financial intermediation, international cash management, credit creation and intermediation in foreign exchange market. As these functions are not regulated properly, there is a need to regulate these activities. They are different way for regulating but all of them need collective effort among host and home government.